Hey everyone, and welcome to this explainer. So today is May 19, 2026, and some pretty wild data just hit the wire. China's massive economic engine, it is suddenly flashing some major red warning lights. Now, if you follow global trade at all, you know China is usually the ultimate reliable powerhouse. But something has shifted, and shifted violently. Let's unpack exactly what these numbers are telling us.
Right off the bat, we've got to ask a crucial question. Is the world's manufacturing engine actually stalling out? Because honestly, April's data from the National Bureau of Statistics came in well below expectations across virtually every single major indicator. We're talking consumer spending, industrial output, investment, the whole shebang. These new figures are aggressively reigniting debates about the actual health of the world's second-largest economy, and definitely increasing the pressure on Beijing to do something about it.
Okay, let's get right into Section 1, Flashing Red Warning Signs, Expectations versus Reality.
To really wrap your head around how severe this shift is, just look at the contrast here. Earlier this year, the narrative was solid, right? The Chinese economy expanded by a healthy 5% in the first quarter. But then April hit. Retail sales, which is basically the broadest measure of consumer spending, grew a measly 0.2% compared to last year. That is a massive, massive disconnect.
And that 0.2%, it didn't just miss the mark. I mean, it completely shattered the 2% forecast that experts had confidently laid out. It effectively dropped off a cliff from March, marking the weakest reading since December 2022. You know, right when COVID restrictions were just beginning to loosen. Consumers are literally slamming on the brakes.
Moving on to Section 2, Consumers and Factories Retreat, a broad-based slowdown.
You see, this weakness really isn't isolated. We're talking huge, double-digit drops across the board for big-ticket items. Automobile sales plummeted 15.3%. Home appliances down 15.1%. Furniture and building materials both took double-digit hits. These categories are incredibly sensitive to consumer confidence. When people are anxious about the future, they don't go out and buy washing machines. They hoard cash.
But hey, it wasn't just everyday consumers pulling back. Over on the production side, industrial output decelerated to just 4.1% in April. To put that into perspective, it was at 5.7% just a month prior in March, and it totally missed the 5.9% growth forecast from a recent Reuters poll. So factories are slowing down their assembly lines at the exact same time consumers are closing their wallets.
And to make matters worse, the big stuff is slowing down too. Look at fixed asset investment. That covers spending on property, infrastructure, and heavy machinery. Economists actually predicted a positive 1.6% growth. Instead, it contracted by negative 1.6% in the first 4 months of 2026. This is a dramatic reversal from the 1.7% rise we saw between January and March. Analysts are pointing directly to slowing construction activity and weaker infrastructure investment. The builders simply aren't building.
Which brings us to Section 3, the Iran war shock, the external squeeze.
So we already know China has been dealing with domestic demand problems for a while. But right now, that internal vulnerability is colliding head-on with a massive external shock. The global fallout from the Iran war is setting off a brutal chain reaction. This conflict is triggering soaring energy and commodity costs worldwide, and those skyrocketing prices are coming right down on the heads of Chinese manufacturers and consumers. It's essentially an imported pressure cooker.
And, well, the data totally backs this up. This war-driven surge in commodity costs pushed both producer and consumer prices higher in April. In fact, factory gate prices, those are the prices manufacturers charge wholesalers, hit a 3-year high. What's absolutely wild about this is that this sudden spike abruptly ended a years-long deflationary streak in China. They were fighting falling prices for ages, and suddenly, boom, inflation driven by a war thousands of miles away. All right, let's pivot a bit to Section 4. The export silver lining, a surprising paradox.
Because despite all that domestic gloom we just talked about, not all of April's data was terrible. Actually, Chinese exports accelerated sharply. While the expectation was a respectable 7.9% growth, the reality was an incredible 14.1% surge. They completely blew past the estimates. At first glance, you might think, okay, the manufacturing engine is totally fine, but we really have to look under the hood here.
But hold on a second, because analysts are cautioning that this export boom isn't exactly healthy, organic, long-term growth. It's actually being called war panic stockpiling. Overseas buyers are rushing to place orders right now, frantically trying to front-run the higher input costs linked to the Iran war. Factories in China are scrambling to meet this surging, panicked demand. So yes, it's a spike, for sure, but it's driven by fear of future price hikes, not sustainable global demand.
Now, to be fair, this export surge did have one positive knock-on effect. It actually helped edge the urban unemployment rate down just a bit to 5.2% in April from 5.4% in March. Strong exports are providing a much-needed buffer, keeping factory workers employed for now. But economists are definitely waving a red flag here, warning that this artificial, front-loaded export boom simply won't be enough to fully offset the massive domestic weakness over the long haul.
Let's wrap things up with Section 5, the global ripple effect, why this matters to you.
So why should you care about all this data, no matter where you're sitting right now? Well, it all comes down to the super interconnected nature of global trade. When the world's largest manufacturing economy stalls out, with consumers, factories, and investors all pulling back at the exact same time, the ripple effects hit global supply chains incredibly hard. Economies like India, which depend heavily on Chinese demand, are directly exposed. If China stops buying, their neighbors stop growing.
So, what exactly should we be looking for next? To get back to that 5% growth rate, Beijing really needs a meaningful recovery in domestic demand. Here's your ultimate scorecard for China's next move. We need to watch May retail sales to see if consumer confidence recovers. We need to monitor loan growth figures to gauge if businesses are actually investing again. And perhaps most importantly, keep an eye on the State Council for announcements of concrete fiscal stimulus targeted at everyday households. Look, the government in Beijing has definitely signaled they're aware of the problem, but as we all know, signaling is very different from actually acting. Ultimately, whether they move beyond mere words to actual stimulus will determine just how deep this economic slowdown runs. Which leaves us with this vital question. Will Beijing step in with the massive, concrete action required to restart the engine, or will this historic stagnation drag global growth down with it? Keep your eyes on the data, folks. Thanks so much for joining me on this explainer, and I'll catch you on the next one.